Charlie Munger once said, "I did not intend to get rich. I just wanted to get independent." If you want to be rich enough to do what you want, whenever you want, and with whom you want, you need to change the way you think about money and build a strong investing mindset. Understand these 3 concepts that people get wrong, and you'll end up with an unbreakable investing mindset. Let's call these the 3 money misunderstandings, okay? Now, let's get to the first one, shall we? Money misunderstanding number 1, compounding. If I give you $1 on January 1st and double it every day, $2 on January 2nd, $4 on January 3rd, $8 on January 4th, how much money would you receive on January 31st? $1,000? $10,000? By compounding $1 at 100% for 31 days, you would make $1,073,741,000 on January 31st. However, how much would you receive on January 31st if you waited a week and didn't start compounding that first dollar until January 8th? $250 million? $100 million? No, it's only $8 million. You made 99% less money by waiting a week. People think that Warren Buffett has been the best investor of all time. Buffett is worth about $86 billion right now. But did you know that he made almost $82 billion of his $86 billion after he turned 65? Buffett has made an average annual return of 22% since he was 11 years old. This is twice as good as the average stock market return. But compared to other investors, his average annual return of 22% isn't much. Take Jim Simons, a mathematician who runs the company Renaissance Technologies. In the last 33 years, Simons' investments have given him returns of 66%. But Simons' net worth is only a quarter of Buffett's net worth because Simons' money has not grown as much over time as Buffett's has. Start getting to the point where you can live on your own by investing in assets that go up in value, stocks, bonds, commodities, gold, etc., and giving compounding time to work its magic. The first rule of compounding is to never stop it for no reason, says Charlie Munger. Many smart investors don't follow this advice because they get greedy and look for short-term returns. Did you know that Charlie Munger and Warren Buffett also work together with a man named Rick Guerin? People don't know much about Guerin because, when the stock market was going up in the late 1960s, Guerin used debt to increase his returns and make his money go further. But when the market dropped by 70% in the early 1970s, Guerin had to sell his stock because he was close to running out of money. Guerin quit the game of compounding because of his greed, but Buffett and Munger rode out the storm and stayed the course. Money misunderstanding number 2, volatility. Volatility is a term that describes the changes in the market. Stocks have a high degree of volatility because a portfolio of stocks can go up or down by a few percent any day. People who can't handle the ups and downs of the stock market, or other volatile markets, invest in low volatility assets like bonds and guaranteed investment contracts, GICs, which have much lower average annual returns than the stock market. Volatility is the emotional cost you have to pay to get high average annual returns. Author Morgan Housel gives a great analogy to help you ride out stock market dips and embrace volatility. You can think of volatility as a fee, not a fine. If you received a fine for parking in an illegal spot, you would stop doing that and try to find another place to park. But if you have to pay to park there, you would gladly pay the fee if it was the best place to park for miles. Investing operates under the same logic. If you own a large stock market index, like the S&P 500, don't think of dips as a sign you're doing something wrong. Instead, think of them as the fee you must pay to receive high average annual returns. Money misunderstanding number 3, tail investments. At Amazon, Bezos made a lot of small bets. Amazon Web Services was one of Bezos's good bets. It started out as a small side project, but it now brings in more than 60% of Amazon's operating income. Amazon Web Services is a tail investment, which means that it outperformed all other investments by a huge amount and made up for a number of bad investments. Don't worry if most of your investments lose money, as long as a few of them make you a lot of money. The author Morgan Housel likes to say, you can be wrong half the time and still make a fortune. In the end, you can improve your investing psychology by constantly reminding yourself to use the power of compounding and accept volatility and make a lot of different investments. Also, you can benefit from a few tail investments. Remember Buffett's compounding curve and start investing right now to make time your biggest competitive advantage. Remember that volatility is a fee, not a fine, and that investments can fail, but as long as you have 1 or 2 investments that do really well, like AWS, you're doing fine. This was The Main Point: The Psychology of Money by Morgan Housel. This is one of the best books I've read in a long time, and any aspiring investor should read it.